Oh, look who it is. Good morning, good morning, good morning. It's me, Kenny Polcari, your host of the party. And this is my third cup of Dunkin' Donuts coffee this morning. So, as you can imagine, I'm all wound up. Today is Tuesday, April 12th, 2022. And what is it? What is it that we need to know and what's happening today? So, it is all about the CPI today. And tomorrow it will be about PPI. Today's report should seal the deal for the Fed, right? So we can expect 4 50 basis point rate hikes because that is the expectation. And unless something big changes, I can't see how that's going to change. Oil lost 3% yesterday, but it's up 3% today as OPEC warns of tight supplies. Earnings begin tomorrow. JP Morgan and BlackRock will kick it off. And what are we having for dessert? We're going to have the Ricotta Easter Pie, but I'll get to that in a minute. So the selling gains speed as we awaited today's CPI report. By now you know the drill. It's expected to show an increase of 8.4%, which is back to 1981 rates, right? That's the official estimate. But the window does go as high as 9%, which I think is a bit aggressive, but may not be by the time we get to summer. Food, energy, housing costs are all at the core of the increase. And to be clear, these are all things that we need on a daily basis. These are not optional items in your daily life, which is why this is so significant and concerning. So today's report will most likely put to rest what the next Fed moves will be. 50 basis point is now the expectation for May, June, and July, and possibly September. I think yes, but there's a possibility. Investors are now pricing a 3% Fed fund rate by the year end. And after September, we still have 2 more meetings to make, right? We can make that happen, November and December. So no worries. And if you missed it, everyone at the FOMC is now singing the same song. They all have moved to the aggressive side of the argument, understanding that they chose to ignore all the signs of the building inflation back in 21. Why? Because we all saw the signs, right? We saw inflation building. We watched as the data kept building. Why they didn't see it is beyond me. We were all warning of rising prices everywhere we went, and especially at the grocery store. Yet the Fed was blind, reminding us of the great Oz when he told Dorothy and the Cowardly Lion and the Scarecrow and the Tin Man to pay no attention to the man behind the curtain. The algos continue to initiate waves of sell orders, pushing the markets lower and lower, which leads to more selling as we test and break technical levels. To this point, I said it in my note yesterday, right? I said that the S&P on Friday closed at 44.88, and it tries to hold on to the trend line at 44.92. The path of least resistance feels lower, and a test of support at 44.30 is not out of the question. And who knows, maybe it could happen today. That's what I said yesterday. And guess what? It did happen. Yesterday, as the market moved lower, many thought it wanted to test 44.30 to see if the buyers would defend the position. At 3:21 p.m., when the algos tested that level, it failed. So therefore, the S&P breached that support level, and the algos went into overdrive, creating waves and waves and waves of sell orders as a result of the technical breach. By the end of the day, the S&P lost 76 points, or 1.7%, leaving it at 44.12, a full 18 points below the support level. The Dow fell 415 points, and NASDAQ continues to get beaten up the most, falling 300 points, or 2.2%. The Russell lost 15 points and 0.7%. The transports, again, surprising the markets, rising 57 points, or 0.4%. But remember, the transports were getting killed in the last 2 weeks, down 13% just in the last 2 weeks, well ahead of the broader market. So as the algos go searching for opportunities, beaten up transport names are waving the flag saying, hey, look at me. For example, FedEx, which is down 25% since January and was down 15% just in the last 2 weeks, rose 1.5% or $2.70 a share. And the airlines found buyers as well, even in the face of all the airlines suggesting that they were cutting flights and raising prices as we move into summer. The Jets ETF rising 1.25%. I guess the algos who don't go on airplanes and do not experience the difficulties that we do found this news to be bullish. Or maybe it was just a short-term opportunity to day trade. In any event, the transports rose on a down day. Every one of the 11 S&P broad sectors was lower, right? Energy lost 3%, but it's still up 39% year to date. Tech fell 2.5%, down 15% year to date. Consumer discretionary fell 1.2%, leaving it down 14% year to date. Communications gave up 1.3%, leaving it down 13% year to date. And they're the leaders on the downside. Now, while utilities lost 1.4%, they are still up 6% on the year. Consumer staples gave back 0.3%, but they remain up 1.7% of the year. And healthcare, while it fell 2%, remains flat on the year, which goes directly to my point about being in the value defensive sectors of the market during this turbulent time, because while they're not up significantly, they are a win compared to the broader market. The value trade fell 0.9%, but remains flat on the year, which is a win. And the growth trade fell 2.5%, taking that down 13% on the year. Clearly, the contra trades did well yesterday and may do well again today if the market continues to go lower. Dog rose 1.2%, PSQ up 2.4%, and the S&P short up 1.8%. Disruptive tech ARC fell another 1.4%, leaving it down 37% on the year, while the contra trade SARK, S-A-R-K, rose 1.25%, leaving it up 37% on the year. Even some of the strongest trades of late, like metals and mining and fertilizer names, came under pressure yesterday as traders rang the cash register trying to create alpha in a down tape. The VIX, which is the fear trade, spiked higher, also discussed in yesterday's note, rising 15% to end the day at 24.34, suggesting that investors are expecting more potholes in the days ahead. The 10-year Treasury yield jumped to 2.77%, sending bond prices lower, and this morning the 10-year pierced 2.83% and will likely push higher when the CPI report is officially released at 8:30. Oil, that sold off 3%, like I said, to end the day yesterday at 95.18 on the China demand destruction story. But this morning, oil's up 3.25% at 97.35. More talk of supply disruptions while OPEC warns of tight supply, saying it was impossible to increase output enough to offset lost Russian supply. Well, this may not have been the issue if current U.S. energy policy was not so restrictive, but hey, that's another conversation, and what do I know? In any event, later this week, we get the beauty pageant, right, which is earnings season. Tomorrow's going to bring us JP Morgan and BlackRock, right, in the financial sector. JP Morgan has already warned of losses due to Russian exposure. The estimate calls for them to report $2.71 a share. BlackRock is expected to report $8.90 a share, but they've been mum on the Russian exposure. But remember, BlackRock is well entrenched in the administration. Brian Deese, a former BlackRock employee, is advisor to Joey, while Mickey Pyle, also a former BlackRock employee, is an economic advisor to Kamala, which leads you to ask, why does she need an economic advisor anyway? And BlackRock is the asset manager that is overseeing, guess what? The Fed's bond portfolio. So my expectation is for BlackRock to once again report stunning numbers as they do quarter over quarter. But even with good numbers, will these stocks see a bounce or not? We don't know yet, right? Both these names are down about 21% on the year, below all three trend lines. So it's anyone's guess what happens next. Look, from a long-term perspective, I like the sector, but I want to wait to see how the markets react when the numbers are released. I mean, you could buy the stock down today, down 21%, or potentially tomorrow buy it down 25%, right? And if the market likes what it hears, it'll trade up. Okay, so then I'll only buy it down 19%. You got to put it in perspective based on your time horizon. Rising rates will, in the end, benefit the big banks once the yield curve uninverts, because with an inverted yield curve, it'll be tough for the banks. But I suspect that too will change, and patience is a virtue. This morning, U.S. futures were down overnight, but they've turned slightly higher as the sun rises over the Atlantic. The Dow now up 14 points, S&P's up 5, Nasdaq up 40. The Russell's ahead by 4 points. Nothing to get really excited about, but markets are trying to stabilize ahead of the CPI number, right? And like I said, today it will all be about CPI, and tomorrow it will all be about PPI, which is expected to show wholesale prices rising by 10.6% year over year. Stocks in Asia ended mixed, with China and Hong Kong both up on the day after getting slammed on Monday. Videos of those locked down Chinese citizens screaming from their windows are all over the news and the internet. Xi telling the world that the U.S. is exacerbating the problem by lying about what's going on in that country. Right. The same way the world is lying about what's going on in the Ukraine. But that's another story, right? And that leaves me, though, to ask once again, how did we get caught being so dependent on a communist nation for so much of our supply chain? What were government and business leaders thinking? Now, look, that's a rhetorical question. There's no need to answer it. It's just a rhetorical question. But it's one that's very frustrating, right? When you see what's happening happen. European markets are also under pressure this morning. German banks getting slammed as an undisclosed investor sells massive stakes in both Deutsche Bank and Commerzbank. Word that Russia is using chemical weapons in Mariupol is raising concerns across the continent and the world. UK Foreign Secretary Liz Truss working urgently to verify that story, but it is in the news. Also in the UK, inflation continues to surge at a pace not seen since 2014. Thursday brings us the latest ECB policy announcement, and at 7 o'clock this morning, markets across the European region are all down about a 0.5%. Bitcoin this morning is trading at 40,000 after piercing that yesterday, trading 39 and change, and Ethereum is trading just over, or just at about 3,000, right? Both of those are down from their highs a couple of weeks ago. The S&P closed at 44.12 last night, breaking the trend line support at 44.30. We might get a bit of a bounce today, but I still think the path of least resistance feels lower. Now, to be clear, the S&P is nowhere near testing the lows of January at 42.20 or February 41.30, so there's no reason yet to light the whole place on fire. But I am not sure that we won't retest those levels as we move through earnings season. So just be aware, right? Just understand that is clearly a possibility and then take advantage of it if it happens. Okay, so today we're having the ricotta pie. Now look, I recorded this video and then I had to re-record it because I completely forgot to tell you to include the ricotta cheese. This is a classic Italian dish, right? The Italian dessert. Certainly at an Easter time, it's very popular, right? So this recipe today comes from a friend of mine. You can find him on Twitter. It's Stock Charts, right? At ITZSTOCKCHARTZ. He always has great insight into stock charts and the markets, and he always has an opinion, which is what I love about him. Okay, for the filling, and here's where I screwed it up. You need 2 pounds of ricotta cheese, 1.5 cups of flour, 1/2 cup of sugar, 2 egg yolks plus 1 egg white, 1/2 shot of Alchemy's liqueur, which is a full-bodied liquor that's a bit spicy, that has hints of citrus. For the crust, you need 1.5 cups of flour, 1/2 stick of softened butter, 1/4 cup of whole milk, 1 tablespoon of sugar, 1/2 teaspoon of the liqueur again. Now preheat your oven to 325 degrees. Now you want to make the crust, right? So you mix all the crust ingredients, knead it, let it rest for 20 or 30 minutes, then separate like 75-25, leaving 25% of the dough on the side to use for later. Roll out the balance with a nice rolling pin, right, on your counter to fit a 10-inch pie dish. Now use the mixing. Pour all those, the filling. Take all those filling ingredients, put them all together, mix them up nice, and then pour that into the crust. Using the balance of that dough, roll it out, and then cut it into strips so you make like a lattice type of covering on the top of the pie, right? Not difficult to do, but it really looks great. Put it in the oven, bake it for 50 minutes or so, and check it. If you need a little bit more time, give it about 5 more minutes or so, but do not bake this any more than an hour. You want it to have this nice golden color. You don't want it to get too dark. You want it to have this beautiful, nice golden color. In any event, take it out, let it cool. It makes a delicious dessert. I mean, really, really delicious dessert. In any event, looks a little bit cloudy out, although it's not supposed to rain today. It is supposed to get warm and humid here in Florida, but it is what it is. Until tomorrow, take good care.